We're live.
All right. What's up, social world? We're back again for another episode of the Legacy Builder practice to see about getting you guys, more and more comfortable and have the ability to build financial wealth, to build legacy for your families, to build, things for your future, and to create real, true wealth. And I'm super excited to be joined here by my great friend, my business partner, and just a guy with an exceptional track record. I'm sure you've probably heard of him, and this won't be news to you guys that are following us frequently. But Dana Cornell, welcome to the show, brother.
Thanks, man. Happy to be here, buddy. Appreciate it.
Absolutely. So a couple quick housekeeping tips. You guys are just joining us. And if you find value in this, please share it as we go. Share it on your wall. Invite your friends to get on this thing. And then last but not least, make sure you hit the subscribe link. We're going to be bringing you guys great content like this consistently. And if you want to get live notifications, you got to hit the subscribe link so that you'll find out from wherever platform you're on, whether you're watching us on YouTube, Facebook, or I think we might even be on LinkedIn right now. But Dana, let's just get right into the meat and potatoes, man. I don't want to drag people through a long and crazy interview, but we're talking about 5 roads to financial freedom, right? How do people really start to get out of the rat race, create opportunities? We hear about multiple streams of income and all these different possibilities. And man, your background, and you can probably give us a 5-minute on what you used to do, but used to manage massive amounts of money for let's just face it, for wealthy people, right? So how'd they get there? We'll talk about that for a second.
Yeah. So, and it's interesting when you brought this concept up, and I think, I kind of thought on 5 key things that stand out as my last 15 years. I was at a major investment firm, managed well over $1 billion for a lot of households, right? And it was all shapes and sizes, people that built it on their own, people inherited, so on and so forth. So I kind of took 5 things that stood out of people that really excelled above most. And they're all things that probably most of all of us have already read somewhere or have heard, but you probably glanced over it maybe and didn't really pay as much attention to it because it sounds so simple.
Sure.
So, I think if I break that down and where I would start with that, my first kind of key road to financial success would really be proactive in your finances. And what I mean by that is you have to know where your money is going. It's a contact sport, right? You can't sit back and just assume things are going to be okay. You need to be very deliberate and thoughtful in how you're spending your income and where it's being directed.
Yeah.
And you can take it as far as, I'll tell you my personal, I've got a lot of things going on. You and I have a lot of business going together. I'm doing all kinds of things. I hired a bookkeeper to run my personal finances, right? That's kind of extreme. Most people don't do that, but you got to pay attention to it. That's like the blocking and tackling of where you start on a successful path, right?
Yeah, and reality of it is too. It doesn't have to be quite that. If you can't afford it, or if you have the limiting belief that that's too much for you. I mean, you could start by probably a Google spreadsheet or something, right? But the problem is nobody has a checkbook anymore. Nobody balances a checkbook like they did 20 years ago, right? So, just having some sort of plan with an outcome-based focus is probably just pretty much the same thing that what you just said, right?
Yeah, I mean, my example is, like I said, it's extreme, right? But that works for me, and it works for a lot of clients. And for the people that didn't want to spend the time and the effort, it was worth them to spend a couple $100 a month to go have somebody do that. Yeah. You ask our grandparents or our parents, they knew exactly what they had, to your point, down to the penny, because they managed their checkbook every day. Yeah. So that's really where you have to start, in my opinion. And it's
we got that foundation. Go ahead. Sorry.
That's just probably one of the most overlooked things to get you off on the right foot.
All right, cool. So we got the foundational level. What's step 2?
Really, and this is, out of all of the things, this probably is one of the, by far the most important. It's really know what you own and why you own it. So I can't tell you how many times I've seen someone sell a business or somebody just diligently save over the years, and too often all of their money goes into investment products. What I mean by that is mutual funds, annuities, pooled investments. Those are designed to keep investors in the dark. They're designed to be complicated and not very clear in what's happening there. So really nobody asks a lot of questions. It's just too cumbersome to get into. So if you don't understand what you own and why you own it, it's very hard to understand where that's taking you and how you're going to get there. And it leads to just an uncomfortable situation. And most successful people that have saved enough to survive on their own, they don't work that way, right?
Sure.
So
Sure.
That was a big disconnect for a lot of people, and that's where I had a lot of success building my prior business, is just helping people connect those dots and really figuring that out. And quite honestly, that's why I made the shift to focus on income producing physical assets. Everybody can understand why you own a piece of property and people pay you rent for that property and how it appreciates. So I don't know a better way to do it than that. That's why we made the shift, but that's just one example.
I love it, brother. And I got to share kind of a personal story because, I hope people realize how impactful that step is, coming from a guy like you with your background, had over $1 billion managed. And, it was over a year ago, you and I sat in St. Thomas and we were talking about this exact same thing. And, we were friends, but I didn't know quite exactly the level you were at and who you were managing money for and all that wealth stuff. And you had shared with us something similar to this, which was like, look, my job is to put people into financial products, but not necessarily, that they understand the financial products, the ramifications of it and what they're trying to build. So the diversification of that is so important. And you're coming from one of the top wealth management companies in the planet, right? So to hear someone like you say that, it was super impactful for me.
Yeah, well, I appreciate it, man. And it's just the truth, right?
Yeah.
You don't hear it a lot, but
yeah. Well, you don't hear it a lot because it's a matter of, where are you getting your resources from, and where are you getting your guidance from, and a lot of those unfortunately financial institutions are pushing a certain product, right? They don't have access to a lot of other products. So yeah, I'm glad. So I'm glad to hear that. Definitely something I think is impactful for the listeners to understand from where that's coming from. Number 3, what do we got?
So have you ever seen that commercial where everybody's carrying around their number? I love that commercial because it's so true, right? You really need to find your number. And I think this is an interesting disconnect of people know they have to save, know they have to get to a certain point to support themselves, but they really don't know how to quantify that. So you really need to understand how much you need on a top line number. And most importantly, and we'll dig more into this in the upcoming couple topics I have, but how much income can that support, right? Because you only need the top line number to generate income at the end of the day. And then the game is, how efficient can you be in that, and how consistent can you be in that? So you would be shocked to see the amount of people that I've come across in my almost 20 years of helping people with their finances, that and wildly successful people that do not know those two numbers. And that was a big focus that I had in my prior firm, and I still do that today with people, because those are the two driving forces to make sure you're successful.
It's funny. I have to relate that to, I had a coaching client recently, and this happens so often when I talk to people, is they don't know, first of all, let's go back to step 1. They don't know the big picture of where the money's coming and going, but also a big limiting factor sometimes is not knowing the specific number. And to relate it to a recent client, he says, I want to go out and buy $1 million house, right? And he makes way more than enough money to substantiate that, but he's stuck on a house at 750. Like I think it's financially responsible for me to stay at 750. So I said to him, just figure out the number. What's the cost difference? What does it look like, right? What is the difference to go from 750 to $1 million to really buy the house that you really want versus, just getting involved in a deal that makes you feel good about the number or the cost, right? And when you go and do that math, you realize that the difference isn't relatively not that much different. So I think, this works in so many different facets, right? Like if you want something, write it down, figure out what it is, reverse engineer how you get to it, but you have to know that number in order to get to it.
And that's such a good point too. So, when I think of financial planning, right? And if you can identify the two numbers we need to target, then you can track it efficiently. And that's what our conversations oftentimes become is, hey, are we off? Are we on track? Where did we fall short? You can quantify all that. And it gives you such a level of understanding and comfort instead of just conceptually trying to figure it out in your head. When you get stuck in your head, you're dead, right? So
Absolutely.
I hear you.
And write it down. Write it down. I mean, that's gotta be step 2. Literally
Yep.
take some piece of paper, journal it, take a notepad, physically write down, what does that number look like? Are we talking about $5,000 a month, 10 grand a month, 12 grand a month? What does it cost to keep that thing and that asset? And then figure out how you're going to make the money to substantiate it. So I love that. All right. So that's number 4.
So kind of prolonging that point, right? So, and I mentioned this earlier, you need to maximize the income that you're generating from that asset base, and the consistency. And this is where people miss on this. So if you know your top line number, then you need to figure out, like we talked about, how much income can that support, or in turn, how much income do you need to make sure that number supports the income? Well, it's a big difference if that top line number is only going to give you an inconsistent, and I say an inconsistent 4%, because that's what we used to use at the prior firm for financial planning purposes, right? That's an average. That's not a consistent 4%. And we talked about this in St. Thomas, the difference of a consistent percentage versus an average over on $1 million. And this is in our book, by the way, over a 20-year period is literally $1 million more. Or you can relate it to your number. It's 1/4 more money in your pocket without the ups and downs of that.
And maybe you can like just detail that in a little bit, because I think what people miss on that is, let's say you're getting a consistent return, it's predictable income, you're getting a preferred rate or something along those lines, and it's just happening every year, versus you get this argument where people are like, oh, but my portfolio is up 29% this year, beat that, right? But then it drops 10% next year. What's the catch-up rate look like? Because I don't think a lot of people understand that concept.
Excellent point. So, and I can give you a real life example, right? So in 2008, markets are melting down, financial markets, public trade stocks are melting down. If you're in a retirement setting for that, if you have time, it's okay, right? Because you have time to make that up. But to your point, if you're down 20%, you don't need to make just 20% to get back to where you were. You need to make 40% to get back to where you were. People miss that all the time. And then you throw on top of that, if you were living in 2008 and you needed income, you didn't stop needing income. You still need to take that income. So now you're selling your investments on the way down, so it compounds your losses. So you might need a 60% return just to get back to even. So that's why, so that's why percentage returns, average historical returns, are so misleading.
Yeah.
Versus
it can take you years to bounce back from that, right? So you're saying if I'm 68 years old when that happens in 2008, and you know, I'm not still adding, I'm actually subtracting from my net, my pool of money, and I'm literally accelerating the loss, because I don't have the capital to build back up as I'm withdrawing.
It always was entertaining to me to show people, and most people, you know, the stock market, S&P 500 is averaged a little over 7% historically. What people don't understand, so they would try and benchmark that and get close to that. If you average a consistent 4% versus an average of 7%, you were so much further ahead in dollars and cents.
That's a huge takeaway.
Looks like you did so much worse, but you actually did so much better in your account, which that's what really matters, right? And people,
I mean, that's roughly half, no matter how you slice it. Like if you were doing 20 and you know, you really only need 10 consistent to match a 20 or something along those lines, 18 to 10 or whatever that is, right?
And that's why when investments and investment products are presented on, here's the historical average of return. One, the future doesn't look like the past. It might rhyme a little bit, but it's not going to be the same. And it's so misleading. It's a disservice to investors. So
it's almost like it's almost like I don't want to use the term bait and switch, because it sounds maybe too aggressive, but you know, it's definitely a form of kind of pulling the wool over the investor's eyes, that, you know, to make them feel like they're getting what they're not getting.
You know, and I think, you know, by all means, I think most people in that industry are genuine and sincere. It's just, that's a business model. And that business model is to provide a service or a product. It is product driven like that. Right. So just knowing that going in, to me, is knowledge, and knowledge is power. So, you know, hopefully that helps somebody.
I love it. All right, cool. Let's go full circle then. What's number 5?
Yeah. And, you know, I guess I'll number 5 is just kind of big picture, how to protect yourself, but just to back up a step, if you can put those pieces of the puzzle together, and they might seem pretty simplistic, but the biggest thing that throws investors off is not being able to sleep at night, the confusion that brings with finances. And those 4 keys will help you really have a huge advantage by just understanding what's going on and what you own and how it's going to work for you. Right. So that peace of mind, and I would talk about this with clients all the time, that's when you're trying to put a value or a percentage return on something, that's invaluable. So that protects you from making bad decisions. It lets you plan appropriately for your future, for your kids, for whatever's important to you, which kind of leads into my last point. So once you've set all that up, you've got a solid plan, you know you can count on your income, you can reasonably predict where your investments are headed. You need to protect yourself and your family. So then you need to start thinking, and I always reverse engineered that, and you really need to think of who is counting on you and what are they counting on you for and what's important to you. Charities, causes, kids, grandkids, whatever it is. You start to figure that stuff out and put the why to it and the who. That comes first, and then plan comes second. And I think estate planning, just protecting yourself in general, is overlooked. It's something that's confusing and scary, and people don't really understand a lot of it. If you break it down like that and you can lay out and articulate what's important to you and why, then a good planning attorney or just a financial planner can lay out the right plan for you. And then you've got everything buttoned up and you have a little bit of peace of mind that not just you, but your generations past, you're going to be taken care of.
Yeah, I love that. I really believe that that's what separates the top 5% from everyone else in the world, is literally that plan of attack. I kind of jokingly talk about this a lot, that the plan of attack is missing in everybody's, business and life. We plan a trip to Mexico, a 1-week trip to Mexico, right?
Yeah.
We know what plane we're getting on. We know what seat we're sitting in. We know what kind of service we're getting. We know the hotel. We know the transportation. Dude, we know if we're going to have a poolside view or an oceanside view, right? We know what restaurants we're going to, what day our spa treatment is booked. It has a poolside bar, or if I'm going to use the bar. We know everything about a 1-week trip to Mexico. But when you say to somebody, what are your long-term financial goals, right? What do you want to accomplish in the next 5 to 10 years? Shit, what do you want to accomplish this year, right? And it's a gray area for a lot of people. And I think that's a really limiting factor to people finding the success that they expect out of their life.
Which, to your point, right, it puts them in a defensive mode. Right? You're not proactive in it, and they don't do that. And we could talk about the psychology of investing all day long, but they don't plan it like your trip to Mexico because it's scary to them. They don't have the knowledge where you're planning your trip to Mexico. You can go on a million different sites on the internet, and they can help you make the right choices. It's not like that in the financial planning world. So that's why I love these types of conversations and just giving people high level bullet points of what to look for. And if you just apply those 5, kind of keep that in your mind and be thoughtful about it, you're gonna be in pretty good shape.
Yeah, and it's probably not as much fun, let's be honest, to call your financial advisor as it is to call your travel agent, right? But the point is, when you have a good rapport with that person and you know what your plan is and you start to execute on it, it could be every bit as rewarding to do it that way.
Depends on who your advisor is. That was a pretty good time to talk to, but
cool, brother. You're hilarious. So what did we miss? What else do you want the folks to know, or you want to wrap it up and talk? Maybe you want to talk about the book. You just mentioned the book. You got a book coming out?
Yeah, I do. I appreciate you bringing it up. So kind of along these lines, right? I appreciate you helping me and chipping in on that as well. It's just laying out these big picture ideas and really why I went through my transition from a high level position at the biggest investment firm in the world, quite honestly, to focusing on private income producing investments, right? Backed by a hard physical asset. And I haven't found a better way to build consistent wealth. And it's not for all of your money, but it is certainly for a good piece of it. And that's what we do here at Cornell Capital, is help people understand that and how it fits in and make good decisions and do the right due diligence on what project, what type of asset class, what investment is right for them. So
love it.
Yeah.
Who's a great fit for you? Somebody, what kind of client is the type of person that you want to speak with? And, how, if that's the case and people are watching this, how should they reach you?
Yeah. So good question. So I guess to break down who's an ideal client or who we really have the most impact with, just due to the SEC regulations on these types of private investments, you have to be an accredited investor, which means $1 million of liquid net worth minus your primary residence, or $200,000 of income consistently over the last few years if you're an individual, or $300,000 if you're married. Right. So first you have to qualify. I would say our target, if I had to profile who we consistently work with, it's somebody from really $1 million to $10 million of liquid net worth. That's an average. It's a wide range, right? We have people have hundreds of millions of dollars, but that's really where we can make the most impact. Most of those people are not exposed to the types of investments that I'm bringing to the table. Yeah. And that's where I think that's the unique value of Cornell Capital. So you can find us at cornellcapitalholdings.com. It's dana@cornellcapitalholdings.com is my email. I'm happy just to field any questions that can help people. We're here as a resource. We have an attorney on staff full-time, commercial banker of 23 years running numbers for us, myself. So it's a pretty solid team just to help you guys be successful financially, build a legacy, right? That's what it's about.
Awesome, man. Yeah. Matt just put the URL there in the bottom so you guys could take a peek. Again, if you feel like you might be in that situation, you might be accredited, even if you're on that borderline. I know there's some people like, because let's say they're just shy of the income, right? But they get a little afraid of, well, is my liquid net worth, $1 million?
Yeah.
There are some there's some extenuating circumstances, right? If you can explain retirement income and things like that, is there some ways that people can be accredited and not really know they are?
There are. Actually, it happens all the time. So when people reach out to us, usually you go to our website and fill out a little bit of a profile so I have an understanding of who you are and what you're looking to accomplish, because that's really how we start. I need to know where you're at and what you're trying to do so I can match you to the right situation. Oftentimes people answer, I am not accredited. We have a quick conversation. I explain, because there's a number of nuances that, really are a little bit too in the weeds for this conversation, but we walk you through that. And more times than not, people figure out they are accredited. They just didn't count something or didn't realize that qualified or didn't categorize it in the right way. So yeah, excellent point, man.
Yeah, there's a lot of ways to kind of cross that threshold based on where your assets are and what the assets are and what the long term. And again, it's a little too in the weeds, but I do want to make sure that people realize if you think you're on that tipping point, it's definitely worth a conversation with Dana just to find out, hey, am I really accredited? Because you can also authorize people to make sure they're accredited and verify that. And then even if they do deals elsewhere, at least they know that going in. Right. So I think that's a good service for you to have a conversation with.
Absolutely. Doesn't take very long. So happy to do it.
Cool, brother. What did I forget to ask today, or what else do you want to cover? Anything?
I don't know, man. I think we hit some pretty good points. Anything else you got for me?
No, man. I think we're going to definitely do this more often. You guys will see Dana more often, on these type of interviews. If you have any questions or you're watching the replay, post the questions in the comments. We'll get back to you. We'll circle back to you if you're looking for us to private message you. And as well, if you want to contact Dana directly, go to the site. You can talk to him. You can get that accredited investor, authorization or figure out if you are accredited. I think ultimately we laid out a good game plan here for success and long-term wealth building. So Dana, I appreciate you coming on.
Yeah, I appreciate it, man. I just want to add one more thing before we close. To the point of know what you own and know why you own it. We built a tool, and I'm happy to do it for anybody. Obviously, you're not a client. We don't have any skin in the game. But if you really want to break down what you own and why you own it, I'm happy to run the analysis for people, especially if they mention they came through you in this situation and,
perfect.
Provide some clarity for people.
Perfect. Well, there you go, guys. You get somebody who's managed over $1 billion in assets, willing to help you and do some clarity, all because you're part of whatever group or wherever place you listen to this right now. You got access to it, so you can reach out to Dana directly. So, Dana, I appreciate you, brother. Thanks for coming on, and look forward to doing this again soon.
Same here, man. Always a pleasure. Talk soon. All right. Bye.